Okay, in this training, you will be given 5 ways to get dividends out of Bitcoin. Really, this is about getting some kind of yield out of Bitcoin. And as you very likely know, if you self custody Bitcoin, you cannot generate any interest or any dividends or any yield. That's why this video is so exciting. Hi, I'm John S. Rhodes of the Rhodes Brothers, and welcome to Greater Wealth Through Mastery. And we are indeed going to be talking about how to get Bitcoin dividends. Now, I say that very loosely, and again, I must caveat this by saying there is no way at this point in time to self-custody Bitcoin and generate any kind of yield. You can't just hold on to a bar of gold and expect it to spit off cash or to give you dividends or to give you yield. It's the same idea with Bitcoin. You cannot just get yield. That's why this is so exciting to me, is that you can have Bitcoin, you can own Bitcoin, and you can generate yield. So let's dive into how this works. One last thing. This is not investment advice. This is not meant to be financial advice whatsoever. This is for infotainment purposes only. Woohoo! All right, so let's dive into the 5 ways to get Bitcoin dividends. Now, number 1 is that you can convert your Bitcoin into other assets that do generate a yield or in some way have the ability to generate yield, right? So they either generate it or they sort of indirectly generate yield. And one of those ways is through something like USDC. That would be a stable coin. You can convert Bitcoin into USDC. You can then stake it and earn interest. So when you stake a coin, you can earn interest or earn a yield. So the way that you would do that is you would stake USDC on a platform. So you wouldn't be able to do this yourself. You would want to be doing it through a platform, right? A token exchange, that kind of platform. And then that makes room for you collecting dividends or really collecting interest and income for making that particular asset available to uphold and withhold and stabilize the network. And really what you're doing when you stake is that you are locking up your coins. You're locking up the asset and you can't touch it. It's a lot like a CD or a certificate of deposit. Now, this is pretty far reached, right? This is like, we're really grasping at straws here, but it is something that you can do to stay in a crypto ecosystem. Again, Bitcoin to USDC, stake it, set it aside, collect interest, and then turn that USDC back into Bitcoin. So this is kind of a cheat. It's not awesome. It's not great. It is not a direct way to earn Bitcoin yield, but basically there is no direct way, but we can use mechanisms like staking to generate a yield nevertheless. So this is not my favorite, not by a long shot. Let's continue on to the second way to generate a Bitcoin yield or something like a dividend. So you can trade futures and options. So for example, you could sell call options on Bitcoin and collect those upfront premiums. So this is playing with derivatives, and that can be very toxic. It can be very challenging. It can be something that you want to completely avoid. But what you're doing is you're using a Bitcoin trading platform to earn or generate a yield or dividends by playing the futures game. And again, you can, sell calls, you can sell puts, and you can play a trading game on a platform. So that's another way, as again, using futures and options and derivatives. But again, it's not awesome. You're not directly holding the Bitcoin to make this happen. You're not just buying and holding Bitcoin and generating dividends or generating a yield. You have to use a platform. You need to be playing with derivatives, which really means you're playing with leverage or borrowed money in most cases. So the risk is significantly higher. It does allow you to use Bitcoin, but not directly. Okay, so it's not like you have this Bitcoin and it's like, hey, I get all this yield or this extra cash just by having Bitcoin. In fact, it's almost the opposite because you don't have the Bitcoin. It's futures contracts, things that are going to be happening in the future. So again, not my favorite. Definitely not by a long shot. So that's number two. Number three, and this is something that Warren Buffett opened my eyes to. There are people that say that Berkshire Hathaway is no good because it does not generate a yield. There's no interest, there's no way to get money directly from Berkshire Hathaway just by holding it. And to be clear, Warren Buffett is the founder and currently the CEO of Berkshire Hathaway. He loves collecting dividends, but he doesn't like paying dividends. Now, a lot of that, we're told, comes from his position on tax, his thinking about paying taxes with collecting dividends inside Berkshire and the operating companies. He pays a very low tax rate, and that's something that can shield investors from paying those dividend taxes. So again, Berkshire Hathaway collects dividends like crazy, but they're taxed at a very, very low corporate rate. If I remember, it's something like 7% somehow, which is really tremendous compared to, let's say, 15% that you or I might pay on qualified dividends. And that's just an example. The rates change here and there willy-nilly, so don't hold me to the exact percentage there. But we pay more when we collect dividends, when we hold stocks that pay dividends. But the dividend rate really isn't that bad. The taxes on the dividends really isn't that bad. Now, again, back to Berkshire Hathaway and Warren Buffett, he doesn't pay a dividend, but he says you can create a dividend by holding on to Berkshire Hathaway. But occasionally, what you do is you sell a small portion of your Berkshire Hathaway stock. You pay, typically, in that case, for a long-term holder, you pay a long-term capital gains tax, which is lower than ordinary income, right? If you just look at your taxes and you're a higher tax bracket person, you'll see like, oh, rather than 20%, it's 24% or 28% and on up. So if you've got Berkshire Hathaway and you've been holding it for a long time and you sell off a small portion, I believe that you're going to be paying long-term capital gains taxes of about 20%, if I recall. So the taxes can be lower. And the other thing is that by selling shares of Berkshire Hathaway, you have control over how big, how much, in other words, and when those transactions take place. It's like having money in the bank. Therefore, you don't have to worry about waiting for any kind of schedule like it's quarterly or it's monthly cash coming in. So it's what Warren Buffett likes to call a synthetic dividend because you are creating it and you're just riding on top of the gains that you're going to expect to see with an operating company that's profitable, Berkshire Hathaway. So Berkshire Hathaway continues to do better and better over time. Now, obviously, the price of Berkshire Hathaway goes up and down as well. But the point is that by holding it over a long period of time, it's likely to go up, and then you can decide when you're going to sell a pinchy of your Berkshire Hathaway and then take that money out as a dividend. So you can create your own dividend, which is the key. Now, this is one of the better ways to get yield out of Bitcoin because the parallel should be obvious. You can be a hodler. You hold on your Bitcoin. You just hold on, right? You've got your Bitcoin. And then when the time comes, if necessary, then you sell a pinchy of your Bitcoin. And you can do it on a regular basis. So you could do it, monthly, weekly, quarterly, yearly, whatever it happens to be. You can, sell a portion. You could sell a percentage. You could sell a certain dollar amount. There are many ways you can think about what would be best for you, best in your situation. And I say, go for it if you've got most of your wealth in Bitcoin with a little bit of money in fiat, in US dollars, and in other places. But for the most part, the way of getting that dividend is very simple. Buy Bitcoin, hold Bitcoin, sell a very little small pinch of Bitcoin, and that will create the cash flow that you desire. Now, you are selling your Bitcoin and the vault decreases ever so slightly in size, but the idea is that the value of your Bitcoin is outstripping or growing faster than the amount of money that you would take out by selling. All right, so even though you have less Bitcoin in terms of the count, right? You go from 1 Bitcoin down to, 0.95 Bitcoin. So you sell 0.05 Bitcoin and then you take that cash, that fiat, and immediately use it for whatever. Okay, so that's just a quick example. Like, okay, so my Bitcoin holdings go down, but yeah, in 4 or 5 years, that 0.95 Bitcoin, because you sold 0.05, would be much, much, much higher because Bitcoin is going up over 4+ year cycles like crazy. Okay, so that was a long explanation, but it kind of gives you an idea about how and when and why you would be selling Bitcoin to generate cash flow. And the cash flow would be turning, your Bitcoin into dollars, US dollars in this case, and then using that for whatever kind of real world transaction you might want to take place in. By the way, this all assumes that the US dollar is still alive and well, and this assumes that you don't have anything else of lower value that you'd want to sell, and this assumes that you're not trying to tax loss, harvest, and so on. So there's all these nuances. I completely understand that. If you have questions about anything like that, you want to know more about, let's say, tax loss harvesting, why or why not to do it, let me know in the comments below. My brother Matt and I take a very close look at these things. Okay, so that's number 3. Number 4 is you can buy into Bitcoin ETFs. Now, in the past, I've mentioned IBIT as an example of a Bitcoin ETF, and I'm pretty sure that IBIT is BlackRock's Bitcoin ETF, but that's not what I'm talking about. I'm talking specifically about buying into MAXI, or into YBTC. That is the letter Y, XY, YBTC. Now, why would you buy into Maxi or YBTC? Well, the BlackRock ETF, IBIT, is in theory, at least, holding actual Bitcoin, custodying it directly or indirectly, wink, wink, through Coinbase. So I'm going to say that again. So if you're buying into IBIT, that Bitcoin, at least a portion of it, is very likely in cold storage in the Coinbase vaults. So do your own due diligence, look into this. It's fascinating. We've actually done a video or 2 at this point specifically on that topic about how the really, really large Bitcoin ETFs are actually holding money in Coinbase. Fascinating stuff. But that's different than MAXI and YBTC, because those particular ETFs, and I say that loosely because it's not a typical ETF, what they are doing is they are doing things like buying and selling Bitcoin derivatives, the futures that I talked about a short while ago, right? So you can play with the Bitcoin futures in such a way that you're extracting out cash flow, and then as a result of playing the futures market, like YBTC and Maxi, you're able to generate a yield. You are actively trading in Bitcoin futures to generate a yield. Now, there are a lot of people in the stock market who are a little bit more savvy that are buying and selling derivatives. They're buying puts and calls, and they're doing things like straddles and strangles, and they're doing many different kinds of techniques to utilize options to generate yield or extra cash flow. Well, that's what these ETFs are doing. They're doing the exact same thing. They're playing with derivatives and futures with Bitcoin. They're Bitcoin derivatives, they're Bitcoin futures, and they're doing that for the sake of generating cash flow. And that cash flow, of course, for you means dividends. It means, a yield or interest on Bitcoin, even though it's second or third order ownership of Bitcoin. So again, you're not able to buy Bitcoin and self-custody it and then use these ETFs to generate yield. That's not what's happening. In this case, you are investing in a company that plays the futures market. So that's how both YBTC and Maxi work, at least according to my research. If you know something different, or I'm not wording it perfectly, or you'd like to clarify, by all means, let us know in the comments, because I'm probably not quite getting it how you want if you're more advanced and more savvy. All right, so that's a 4th way to generate a Bitcoin dividend or get a Bitcoin yield. And these are things that are very interesting when you think about them. You put them together, you're like, wow, I can generate money from my Bitcoin, or I can use Bitcoin as as an asset. I can sell some off. I could use some of that cash to, there's lots of ways to start manipulating and moving that money around to generate a yield. Okay, number five is, I call this the barbell strategy. So for every dollar you're going to invest, let's say $100 or $1,000, for every $1,000 you're going to invest, you would invest, let's say that you're a Bitcoin mostly maximalist, right? So you're mostly like, yes, I'm all in on Bitcoin. Okay, maybe not all in. I'm very much in. I'm super interested and I want to hold a tremendous amount of Bitcoin. Fantastic, but you don't need to hold 100%. Now in the future that might be entirely reasonable and rational and so on, but maybe to generate yield, what you can do is buy 90% Bitcoin and then 10% would go into, let's say, a high dividend stock or a high dividend fund, right? It could be a closed end fund, it could be an ETF, an exchange traded fund, but what you might do is put 90% in or 80% in and then use that 10 to 20% to generate a yield from another type of device or another mechanism or a security. And I'll give you an example. By the way, this is like the Warren Buffett method in that it's a synthetic yield on Bitcoin. It's a synthetic yield. So you still own Bitcoin and you can still self-custody Bitcoin this way, right? So $1,000, 800 would go into Bitcoin and 200 would go into a, let's say, a high dividend stock, for example. Like an example to get somewhere around a 10% yield, not on Bitcoin, but a 10% yield on a stock or a fund would be something like USA, right? It's the Liberty All-Star Fund, and they pay, I don't know, somewhere between like 7 and 10%. Kind of depends on the timing and when you're seeing this, but they pay between 7 and 10%. But let's just make it 10% to keep it clean. That would mean for every $1,000 invested, assuming you did it 80-20, every $200 would go to USA. Again, just one of many examples. And so 10% on 200 would be 2%. Overall, for $1,000, you would generate whatever that would be, like 20 bucks, right? So a thousand goes in, 800 in Bitcoin, 200 in USA, 200, that's 20%, and then 10% of 20%. Whoa, I know, 10% of 20% is 2%. In fact, I might be able to do this and show you what I'm talking about here. So if we say, all right, so we've got $1,000 and you're going to immediately subtract out 800. So you're going to subtract out 800. If we do that, you're left with 200. So $800, that's in cold storage in your Bitcoin wallet, but you've got 200 left. And if you've got 200 out of the 1,000 and you're getting a 10% yield, to keep it clean and simple, a 10% yield on 200, we're going to multiply, so times 0.1. 0.1 is 10%. There's the 0.1, and that's going to generate $20. It's going to generate $20 on the entire 1,000. That's why it's the barbell. On one end, 80% is in Bitcoin and 20% is in this high yield 10% product, and you're making 20 bucks. And if I take 20 and I divide by the entire amount, which is 1,000, right? There's 1,000, it's going to be 0.02, which is 2%. So if you want to generate a 2% real cash yield on $1,000 and still have it in 80% of it in Bitcoin, that's how you could do it. Again, 800 and 200, you get 10% on the 200. That gives you a 2% yield on all of your Bitcoin, on the 800 that you put in. Well, really the $1,000 total between the two when you combine them. So you can think about it both ways. You can kind of split them apart and think about each part, or you can say I put $1,000 in, 80%, 4/5 of it, 4/5, 4 out of 5, right? 4/5. 4/5 is Bitcoin, and 20%, 1/5, 4/5, 1/5 is in a high yield stock, very high yield, and it's only 20%. So the risk is relatively low on that product. If something goes crazy and wild with it and like, you're earning 10%, which ultimately turns into 2% in a very heavily weighted toward Bitcoin portfolio, right? That's awesome. And a little small pinch, 1/5, 20% is in that high yield product and you still earn that 2%. So I really like that method because you're holding so much Bitcoin and you're still getting some cash yield and you do not need to sell any Bitcoin. Now, let me say that again. You take $1,000 and you never have to take out any Bitcoin and still earn 2% on the $1,000. 2% on the $1,000. And that's because you're getting 10% on 200, which is the 1/5. Now, I know the numbers are kind of like wacky and you might have to pull out a spreadsheet or do this on your own. I can do it pretty fast in my head. I like to use my calculator as you saw, but I encourage you to do the exact same thing and say, well, what about 90-10? What about 95-5? And what kind of yield would I need to get? 5%, 8%, 10%, 2%? Like, what are the percentages? And you can start running that math for yourself for fun to figure out, hey, how do I get a 2 or 3% yield on my Bitcoin or heavily weighted Bitcoin portfolio? Now, this will not work for a very, very, very low dividend paying stock. Like, so if the stock was only paying 1%, you'd earn almost nothing. Then 800 in Bitcoin and 200 in a 1% paying stock, you'd earn $2. Right? Because 1% of 200 is $2. That's no yield at all. There's no cash. That's almost nothing. So again, that's why the barbell is so powerful. And that's why reaching for the yield somewhat safely is a pretty darn good way to make things work. So it's very exciting. When you think about this, it's very, very exciting. And I encourage you to think logically and to utilize the bigger picture of your investment portfolio and say, how does this fit in? How does this Bitcoin yield or Bitcoin dividend work for my entire portfolio? And some of that logic and some of that thinking, the process-oriented thinking, you will see some of that in the next video, like the exact, how do you systematize? What about these processes? What about planning ahead? What about goals? In that next video, you'll actually feel that. You'll understand that when you check out that next video. So I'm John S. Rhodes of the Rhodes Brothers, and go ahead and subscribe to this channel. We will see you in that next video. Thank you. Take care.